So now we are doing a question of a conversion of a partnership, that is conversion of a partnership to a limited company. So this is a question of 2014 December. So they said that, that the financial year, so this is the question here, that the financial year of the company was the same as that of the partnership. So I think if you go through the question, you can see that. Of which I have said, our financial year end started September 2014, which means that our financial year starts on 1st October 2013. So we need to determine, since they say that the financial year of the partnership is the same as that of the company, we need to determine when this conversion took place. When conversion took place. When did the conversion took place? If you can go up there where the question started, they said that here, when did the conversion took place? There's somewhere they said that.
1st April 2014.
So where is that? So it's up there, eh? So this one, eh? So the partners decided to convert the partnership into a limited company, Bama Limited, on 1st April 2014 under the following terms. So which means that I need to record that 1st April 2014. So 1st April 2014. So which means that it was during the year 1st April 2014. So which implies that the first, how many months? From October to April, because October, November, December. So these are 6 months. Eh? Then 6. So which means that since conversion took place during the year, so the first 6 months, it was a partnership. Then the next 6 months, it was a company. So when you will be preparing your income statement, you need to prepare them once, but for the first month, 6, it was a partnership. Then the last 6 months, it was a company. So let us write a partnership and a company statement of comprehensive income. Statement of comprehensive income, that is for the year. So for the year, that is September 2014. Eh? So I will have my 2 columns here. So for the first 6 months, it's concerning partnership. And for the last 6 months, it's company. So remember that in our question, in our trial balance, in order to do the statement of comprehensive income, remember that you start from sales minus cost of sales. After that, you get a gross profit. Eh? After gross profit, you add some income to less expenses. But the better thing of this question is that we had already been given what? We had already been provided with the gross profit. We have already been provided with the gross profit. So the gross profit was, so I want to move just slowly so that you will be getting. So the gross profit is, so you can see we were given a gross profit of 33,300. 33, and this is for the entire year. But remember, this statement is for the company and the partnership, because they say up there, the trial balance below was prepared for the end of 30 September 2014, before adjustment, to convert to convert the partnership into a limited company. So which means that this 33,300 you need to share it 6 months, 6 months, of which even you can see additional information. Number one, they said assume sales and expenses accrued evenly throughout the year. So, and you know how they arrived at this gross profit. They took sales minus cost of sales. So 33,300, share it for the first 6 months and there are 6 months. So talk about, so if you apportion the 33,300 for the first 6 months and there are 6 months anyway. So 33,300 times 6/12. Remember that the same will go to the company.
16,650.
16,650. So you record here 16,650 and the 16,650. Then after gross profit, was there any income in that question? Anyway, there was no any income. If you can check on the trial balance, so you less expenses. So expenses do the same. So in order to go systematically, you go to your question, do this. Start with additional information. So if you check your additional information, number one, they say sales and expenses accrued evenly throughout the year. Which are these expenses? Expenses which were in the trial balance. Go back to your trial balance. Go back to this trial balance. Check expenses which are there. Apportion. 6 months for the partnership, 6 months for the company. You can see we are supposed to start from admin expenses, administrative. We have distribution. We have accounting and auditing. Finance. So do that. So start from admin. So if we start from admin was 38. So what I will be recording here. So admin was, so 6/12 times 38.
1,900.
So this is 18. That one would be subtracted.
19.
19, eh?
1,900.
Even this one is 19. Next is all about, there was a distribution. So 6/12 times, it was 24. If you can check in your statement. So this one will be 12, and this one will be 12. After that, there was accounting and auditing. So accounting and auditing, these are about. You have 300 and 300, eh? Then we have finance cost. So that is fine. I think you understand what I'm talking about. So we are done with the expenses which were there in the trial balance. We continue with additional information number 2. Let us go to additional information number 2 and see if there is another expense to record. So additional information number 2, they said there were no purchases or sales of non-current assets during the year. Depreciation is to be provided based on cost at the following annual rates. So we have motor vehicle and furniture and fitting. So this is depreciation. Let us start with the depreciation on motor vehicle at 15%. So depreciation on motor vehicle. So remember that we have to talk about 15% terms. It was which figure under that balance of yours?
14,000.
So 14,000.
It's accumulated.
You do what? You minus?
There's accumulated depreciation.
But you don't have to subtract that. Why? If you can see here, they say that depreciation is to be based on cost.
Cost.
Which means that that is a straight line method.
Okay.
So straight line method, you don't have to raise accumulated depreciation. If they could have said that depreciation is provided that reducing balance method is when I could have reduced with accumulated depreciation. But on cost, that is a straight line method. So when it's on reducing balance method is when you have to reduce your accumulated depreciation. So for now, in order to get depreciation for the year, you don't have to subtract accumulated because it was on cost. And this method is called the straight line method. So you take your 14, but your portion for the first 6 months. So you are getting
1050.
1050.
1050.
But remember, I will not record the same for the side of the company. I will not record the same. Why? Remember that motor vehicle was taken over at what figure? If you go up there, they say they say that the partnership decided to convert the partnership into a limited company, Bama Limited, on 1st April 2014 under the following terms. Goodwill to be valued at 4 million and amortized over 4 years. Non-current assets to be taken over at the following values. So motor vehicle was taken over at 12. So that is how now we need to consider the 15% on this 12, not the 14. So this 12. But remember for 6 months, because that 12 is for the entire year. So 15 times 12 times 6 over 12. That is what you record on the side of the company. So what are you getting?
900.
So that is 900. I do the same for the other asset which was there. I think it was furniture or what? Yes, it was furniture and fittings, 10%. So 10% for the partnership, you use 8,000. Then for the company, you will use. For the company, you use what? For the company, you can see the non-current assets were taken over at the following value, 10,000. So the same way I've done. So this is what you are supposed to record. 10,000, that is 10% of 10,000. 10% of 8K times 6 over 12. Then 10% times 10,000.
400.
The first one is?
400.
400. Then this one I can see is 500. So all of this, remember that you subtract. So another expense which is remaining, we go to our statement. Remember that we are done with the additional information for the down here, because they said no, the three directors did not pay or propose dividends. But now, if you go back to agreement concerning on how they were taking the partnership, on how partnership, they said this one, the partners decided to convert the partnership into a limited company, Bama Limited, on 1st April 2014, under the following terms: goodwill to be valued at 4 million and amortized over 4 years. Remember that amortization will be what? An expense. So this one will affect the income statement, but for the last 6 months when it was a company. So we write amortization. 4 million divided by 4, we get for the entire year, but we multiply with 6 out of 12. So amortization of goodwill. So 4 million, you divide by what? Divide with 4, that is for the entire year, times 6 over 12. So that one was, so you take, that is 1,000, this 500, eh? That is amortization under the company. Under the company. So after that, we talk about, after that, we talk about what? Another expense under the company. So note 2, it was how they took the assets, which is fine. We don't have to consider that. Note this one, each partner to be a director of the company. Each director to be a director of the company, earning a salary of 100,000 per month. How many partners were there? 2, Bor and Mary. Remember that under the company, they will be directors. They will be directors, not partners, of which they will be paid a salary of 100 per month for 6 months. So we have to say that Palmer was paying them a salary, and a salary is an expense. So we have to record director salary under the company. So we say 100 times 2 times 6 months. 100 times 2 times 600 times 6. So 100 times 2, that is 200 times 6. This is 1,200. So, which means that I'm done. I'm done with the expenses. I'm done with the expenses which were there. Even if we can read another thing which was there under the company, there was no another expense, because they said here each partner to be issued with ordinary shares equal to their capital contribution. The partner agreed to invite John to be a shareholder of the company on payment of 3 million. So that one will go to the partner's capital account. Then the other information was concerning that the financial year of the company could be 30 September, which was the same of that of the partnership being converted. I think we have talked about that. So that you can give me now the net profit.
Kwa director ni nini?
Go kwa
Help
director.
me read that. Nitasoma hapo tu hizo figures.
So our net profit, after you have computed, you are saying that net profit for the partnership is 11,750, then for the company is 10,100. So after we have the net profit, now the partners will share. Remember that this 11,750 will be shared among the partners. That is before conversion. Remember the conversion took place here. So now let them share this 11,750. Bor and Mary, they will share this amount. But after we have considered what was allowed, of which I said we can allow things like interest on fixed capital, interest on drawing, we have commission salaries, but these things now will be specific what they mentioned in the question. So, but in other questions, you will find that this net profit is given. So that is only the difference. So in other questions, you will find that the net profit was given. So you start from the appropriation account. If the net profit is not given, you start from this income statement. And in some cases, it will be a requirement to do this income statement. That is why you will not be given the net profit. So if you are given the net profit, we could have started with appropriation. So of which now I move next to appropriation account. So of which the appropriation account, so the appropriation account, remember that we are sharing the net profit of the partnership. So the 11,750, we are going to share the 11,750. So this 11,750 will be shared in the profit and loss sharing ratio, but after you have considered what was allowed. What was allowed in the question? What was allowed here? So what was allowed in this question is this. They will say, you can see they said Paul and Mary at the start of this question. Paul and Mary have been carrying on a partnership business for several years, sharing profit and losses in the ratio of 3:2. Sharing profit and losses in the ratio of 3:2, respectively, after allowing for a salary of 20,000 per month to each partner, and interest on partners' fixed capital at the rate of 10% per annum. So what they were allowed was, after allowing for these two, what was allowed is this salary for each, that is per month, to each partner. So which means that 200, that is 20 times 2 times 6. Then and interest on fixed capital, 10%. So let us start with salary. So and you raise, so you subtract that is salary. So the only thing which will be allowed and you add back is interest on drawing. All the other items which are allowed other than interest on drawings, you raise. So salary was a ball, and we have Mary. So salary which was allowed was 20 for 6 months, 20 for 6 months. So this is 120 and this is 120. So you can see this is 240. Then again we raise what? There was something concerning interest on capital on the 10%. Interest on capital 10%. So 10%, that is for Ball and Mary. We have Ball and we have Mary. 10%. You multiply with the balance of the capital account. So the capital account, your amount was? So you go to the capital account.
14 for Paul.
So this one was?
14,000. 14,000.
14 and we have gone
10.
to another question. Sorry for that. So this one, this one, capital is this one. So you have said 14 and 10. This, so this one, 14 and 10, 10, 14 and 10. So 14, we have 10. But remember, you have to reduce it to 6 months because this one, 14 is for the entire year. And that one is 10 is for the entire year. So you reduce for the 6 months, 6 months. So this one would be, because this one, 14,000 divided by 2, 7,500, times 10, 750. Then the other one is 5,000 times 10, this is 500. So this is 1,250. That is fine. So that is, so those are the two items. Am I correct? This is supposed to
Hi, Paul is 700.
700.
This is
Paul.
700 anyway. Fine. So the other is okay. So which means that this is 12, eh? So you reduce, eh? So another thing which was allowed, let's say they could have allowed commission, you subtract. Other than drawings, if there was a drawing, interest on drawing, you add. Only interest on drawing which you add back. Another item which is allowed other than interest on drawing, you subtract. So the only interest on drawing, if it was around, you add back. So that if you are charged, you say profit available for sharing. Profit available for sharing. So the profit available for sharing, so take 11,750 minus 240 minus 1,200. Do that. What are you getting?
10, 3, 10.
Yes?
10, 3, 10.
10, 3, 10. Then share. Share now, profit share. Share among Ball and Mary. In which ratio? 3:2. I think you can see they said that. Eh? The ratio was 3:2. They said after you
Yes.
have allowed, after you have allowed what we have considered, you share that one in the ratio of 3:2. Ball and Mary have been carrying on a partnership business for several years, sharing profit and losses in the ratio of 3:2. After allowing this, what we have considered now, share it. Share 3:2. So 3/5 and 2/5. So times the balance you got 10,100, 10,100. The first one being?
Teacher,
Yes.
teacher, just a second. We are sharing profit share with the amount for company, with the profit, that net profit for the company instead of the profit available for sharing.
See, it's a profit.
You're 10,100.
Oh, sorry for this. I have recorded wrong. It's 10,310. So that is good. So we are supposed to share this, eh? It's only that that 10,100 was in the mind. So you share what you have, eh? The profit available for sharing. The one we have, after we have considered what was around, the balance, that is what we share. So good for that correction. So 10,310 times 3/5, what are you getting?
6186.
61?
86.
That is 6186. Then the other one?
4124.
41?
4124.
So if you added the two, you are supposed to get 10,310. Eh? So that one, it means that we have shared this. Eh? So after you are done with that, you move to the next account called partner's current account. That is how these things flow, by the way. Even if you were never asked about the account, you have to do the same way I'm doing. Any question of conversion. I said if you are not given a net profit, I could have started with appropriation. So that now the balances from this appropriation account, the balances from this appropriation account goes to the current account. Eh? So after that, you prepare your current account, partner's current account. So current account, you have two partners. We have Ball, Mary. We have Ball and Mary. Then we have Ball here, and we have Mary. So which my balance brought down is concerning the current account. So was there the current account? which means that if there is no current account, I don't have to prepare this. I go direct to the capital account.
$1,000
Mhm.
and is it 800?
And 800, that is fine. So you go to your trial balance, you check the two. Go to your trial balance and check the two. So we have 1,000 and, so this is the current account. So there are 1,800. So after that, you just pick the items you have from your appropriation account. So things like now we started with salary. This salary, we have interest on capital. We have, if there was commission, drawings, record, then also profit share. So the items which you subtracted, all of them, they are credited, other than drawings. So if there was drawing, was there drawing? There was no drawing. And interest on drawing is the one which you debit, interest on drawing. So these are the two which you debited. So, but now all of the other items which you subtracted, salary was 120 and 120. We have interest on capital, interest on capital. So interest on capital, we have 700 and we have 500. Then we have a profit share. There was a profit share of 6186. And we have 4124. 4124. And we have 4124. So all of them, you do what? You do the necessary.